Hello, and welcome to the world of accounting and finance. My name is Dr. Annette Moultrie, and I got you covered. Whether you are a seasoned professional or someone who's just willing to learn accounting and finance, I've got you covered. So please hit the subscribe button. Click on the notification bell so you'll be notified of upcoming videos. And if you have any accounting or finance questions, please post them in the comments below, and I will respond to your questions. Again, thank you for watching. Hello, and welcome back to part 2 of completing the accounting cycle. Part 2 of completing the accounting cycle. We will finish learning objective 4.3, where we explain the purpose of journalized and post-closing entries. And hopefully in this video, we will prepare the post-closing trial balance, 5, describe the accounting cycle, use the current ratio to evaluate business performance, and finally explain the purpose of journalized and post-reversing entries. Closing temporary accounts net income for the period. In the case of Smart Touch Learning, the service revenue account showed a credit balance of $17,500. A closing entry is prepared to debit service revenue for $17,500 and a credit income summary for $17,500. So here you see the income summary. And here you see the accounts, service revenue, debit of $17,500, and then the income summary, $17,500. You're closing the revenue account. Step 2, make expense accounts equal 0 via the income summary account. So in this example, Smart Touch Learning has a $3,000 debit balance in rent expense account. It will be closed with a credit to rent expense. So here you see the T account where you have the adjusted balance of $3,000. The balance is 0, but there's a credit balance to rent expense of $3,000. So it will be closed with a credit to rent expense. We prepare a closing entry for expenses by crediting each expense account and making a debit entry to income summary for the amount of the total expense balances. Here in this example, you see income summary, a debit of $8,950, and then you see all these expenses, rent, salaries, supplies, utilities, depreciation expense building, depreciation expense furniture, and interest expense. You see a credit. So you're closing the expense accounts. In a compound closing entry, each individual expense account is credited and the income summary account is debited for the total amount of expenses. The income summary T account after closing revenues and expenses has a credit balance of $8,550. By debiting income summary for $8,550 and crediting Bright Capital for that same amount, we have effectively updated Bright Capital account for the amount of net income earned by Smart Touch Learning during the year. Here in step 4, you make the owner withdrawals account equal 0 via the Bright Capital account. Here in this example, Smart Touch Learning, $5,000 debit balance in Bright withdrawal accounts will be closed to Bright Capital. So you see here with Bright Capital, it has a balance of $3,550. So the balance of Bright Capital on the balance sheet will show that total. And here to your right, you see the withdrawal account being closed. So Smart Touch Learning's $5,000 debit balance in the Bright withdrawals account will be closed with a debit to Bright Capital account. And here you see the accounts and explanation. Now, in the event of a net loss for the period, closing entries 1, 2, and 4 would resemble those executed for net income. However, the closing entry to finalize the income summary count would differ. Here in this exhibit 4.6, it shows the complete closing process for Smart Touch Learning. And here to your right is panel A, giving you those closing entries. Close out revenue, close out expenses, close out income summary, close out withdrawals. And here in Exhibit 4.6, it shows a complete closing process for Smart Touch Learning. Here you see to your right is panel B, which shows posting to T accounts. You have Bright Capital, Bright Withdrawals, Service Revenue, then you have all the T accounts for the expenses, and you see the T account for the income summary. All right, let's continue to objective 4, prepare the post-closing trial balance. Now, after closing entries are recorded and posted, the accounting cycle ends with a post-closing trial balance. The post-closing trial balance is a list of the accounts and their balances at the end of the period, after journalizing and posting the closing entries. It should include only permanent accounts. At this point, since all the revenue, the expense, and owner withdrawal accounts have been closed, they will all have 0 balances. The resulting post-closing trial balance lists only permanent accounts and shows that the debits are equal to the credits. So notice here that the adjusted trial balance for Smart Touch Learning, Exhibit 4.1, and the post-closing trial balance in Exhibit 4.7 are similar. An easy way to make sure that you didn't make an error in the closing process is to compare the adjusted trial balance to the post-closing trial balance to ensure that 1, account balances above owner capital are the same. 2, account balances below owner capital are 0, and then therefore not included. And 3, you want to make sure the owner capital account balance matches owner capital on the balance sheet. Learning objective 5, describe the accounting cycle. So what is the accounting cycle? The accounting cycle is a systematic procedure through which companies generate their financial statements for a given period, encapsulating a series of steps adhered to throughout that time frame. Commencing with carryover of initial asset, liability, and owner's equity account balances from the preceding period, the accounting cycle unfolds a structured sequence of tasks aimed at accurate financial reporting. Here you see in 4.8, Exhibit 4.8, it outlines the complete accounting cycle of Smart Touch Learning and every other business. So you start with step 1, and then you move clockwise. Okay, so this is just an illustration. I'll go over it again. Step 1, you start with the you start with the beginning account balance. Step 2, analyze and journalize transactions as they occur. 3, post journal entries to the accounts. 4, compute the unadjusted balance in each account and prepare the unadjusted trial balance. 5, enter the unadjusted trial balance on the worksheet and complete the worksheet. 6, journalize and post adjusting entries. 7, prepare the adjusted trial balance. 8, prepare the financial statements. 9, journalize and post the closing entries. And step 10, prepare the post-closing trial balance. So you may wonder, why are these letters in front of these steps? It is because it is part of a problem in the assignment. Learning objective 4.6, use the current ratio to evaluate business performance. The current ratio measures a company's ability to pay its current liabilities with its current assets. A company prefers to have a high current ratio because that means it has plenty of current assets to pay its current liabilities. A strong current ratio is 1.5, which indicates that the business has $1.50 in current assets for every $1 in current liabilities. A current ratio of 1.00 is considered low and somewhat risky. Here in this example, Kohl's had the following total current assets and current liabilities found on its balance sheet. As you can see, the current ratio has decreased from 2018 to 2019. Now, this indicates that Kohl's Corporation has deteriorated in its ability to pay its current debts. Given that the current ratio is above 1.5 for both years, Kohl's Corporation would be considered a less risky investment than another business with a lower current ratio. Similarly, creditors would be more willing to extend credit to Kohl's Corporation than another company with a lower current ratio. Here is an example of a problem. Remember, before we proceed, current assets are those assets that are expected to be converted into cash or used up within 1 year or the normal operating cycle of the business, whichever is longer. Examples of current assets are cash, accounts receivable, prepaid expense, office supplies. Those are examples of current assets. Current liabilities, on the other hand, are obligations or debits that a company is expected to pay or settle within 1 year or the normal operating cycle of the business, whichever is longer. Some examples of current liabilities are accounts payable, salaries payable, unearned revenue. So here in this example, you see here, Moultrie Auto Repair has the following account balances at December 31st, 2024 from its adjusted trial balance. Here you want to compute Moultrie Auto Repair current ratio. So the formula for computing current ratio is total assets divided by total liabilities. So to compute the current ratio, you would add up the total assets, current assets, and divide it by your total current liabilities. So your total current assets would be $12,500 divided by 5,000 of your current liability, which will give you 2.5 current ratio. Learning objective 4.7, explain the purpose of journalize and post reversing entries. What are reversing entries? Typically, when accruals are recorded, both an expense, revenue, and a corresponding payable or receivable are documented. In the subsequent period upon payment receipt, the cash flow is recorded, settling the payable receivable, with any discrepancy being reflected as an additional expense or revenue. So reversing entries are typically special journal entries that ease the burden of accounting for transactions in a later period. Now, this necessitates revisiting the original accruals from the prior period, which can be cumbersome and time-consuming. So when the cash flow linked to the accrual materialize, the entire cash flow amount is recorded in the associated expense/revenue account. Here you see in these examples, Smart Touch Learning makes an adjusting entry at December 31st to show it still owes its employees an additional $1,200 for the last half of the month. You see a debit to salary expense and a credit to salaries payable to accrue salaries expense. After posting, you see salary payable is adjusted and salaries expenses is also adjusted. The $4,800 debit balance of salaries expense is closed at December 31st, 2024, with a debit to income summary and a credit to salaries expense. After posting the closing entry, salaries expense has a zero balance, as you see here. Accounting without a reversing entry. Assume that Smart Touch Learning will pay its employees the second half of December's salary, along with the first half of January on January 15th, 2025. So on January 15th, the company would record the following journal entry: a debit to salaries payable of $1,200 and a debit to salaries expense of $1,200 on January 15, 2025. And then you'll have a credit to cash of $2,400 on January 15 to record payment of salaries. Now, this method of recording the cash payment is correct. However, it wastes time because the business must refer back to December 31st adjustment. Otherwise, the business does not know the amount of the debit to salaries payable, in this example, the $1,200. So searching December's adjusting entries wastes time and money. So to save time, accountants can use reversing entries. So after posting the cash payment, the salaries payable and salary expense accounts are what you see here. Salary payable, $1,200 credit on January 1st, 25, and a debit of that same amount on January 15th, whereas salaries payable has a zero balance. And now there's a debit of $1,200 on January 15th to salaries expense. Accounting with a reversing entry. A reversing entry switches the debit and the credit of a previous entry. It is exactly the opposite of a prior adjusting entry. The reversing entry is dated the first day of the new period. Again, the reversing entry is dated the first day of the new period. It is the exact opposite of the adjusting entry. Ordinarily, the accountant who makes the adjusting entries will also prepare reversing entries at the same time. To illustrate, recall that on December 31st, Smart Touch Learning made the following adjusting entry. This occurred on December 31st. A debit to salary expense, a credit to salaries payable. So the reversing entry is dated January 1st so that it affects only the new period. All right, so here you see the accounts after the accounting clerk posts the reversing entry. The arrow between the T account shows the transfer of $1,200 from salary payable to salary expense. Now, this credit in salaries expense does not mean that the entry has a negative salary expense, as you might think. Instead, the odd credit balance in the salaries expense account is merely a temporary result of the reversing entry. Salary expense has a debit balance of $1,200, which is correct and represents only the January salaries. The payment of salaries covered two periods, $1,200 related to 2024 and $1,200 related to year 2025. The salaries expense account should only contain the amount that relates to the year 2025. And this is the end of part 2, completing the accounting cycle. Completing the accounting cycle. So this is actually the end of part 1 and part 2 of chapter 4, completing the accounting cycle. So please watch out for our next video, which will cover chapter 5.